second episode of this special series, Get Started in the Market, where we help you understand the basics of stock market investments. We hope you did get started in the market after our last episode, but in case you missed it, here's a brief glimpse of all that we covered. We'll help you get started in the market.
What really is a stock? A stock is a share in the ownership of a company. You as an investor purchase one part or one share, then you will effectively own 1% of that company.
Let's go ahead to the stock market or the stock exchange.
It's simply a marketplace where stocks are bought and sold. There are two major indices in India, the Nifty and the Sensex. Majority of the trades in India happens through the NSE. A bull market implies an upward movement in the indices, whereas a bear market is just the opposite. It implies a downward movement.
So before you put your money into stocks, here's a checklist of what you need to keep in mind.
Firstly, what are your financial goals? This depends on your age and your money requirements at different stages of your life. Secondly, consider your asset allocation. That is, out of the total money that you want to invest, how much should you put into equity investments, how much in debt investments, and how much in other investments such as gold and real estate. The Securities and Exchange Board of India, or what we commonly call as SEBI, is the watchdog of the Indian capital markets.
Just like you need a bank for savings and other financial transactions, you need a demat account and a trading account to hold, sell and buy shares.
A demat account is where your shares are stored in an electronic form, which means you don't need to manage any physical paper certificates. And a trading account is an interface between your bank account and your demat account for buying and selling shares.
Mr. Sanghvi has decided to open a demat account with Motilal Oswal Securities Limited. Let's get this process started with him.
The main objective of KYC or Know Your Client is that it helps govern your relationship with your broker and ensures that your account is not misused.
Keep your permanent account number or your PAN card handy. It is very important to have this for both your demat and your KYC.
And now, with a trusted broker, a trading account and a demat account, Mr. Sanghvi is ready to part own some of the best companies in India.
Now that you're armed with the basic requirements of trading in the stock market, let me take you through how an exchange really works.
What is a stock exchange and how does it work? An exchange is the main trading platform through which you buy or sell listed shares. The largest stock exchange in India is the National Stock Exchange or the NSE. It is a fully computerized exchange and offers an online trading system, which means members are connected from their respective offices at various locations to the main system at the NSE premises through a high-speed satellite telecommunication network. So what really happens when you click on the buy or sell button? The exchange uses a trading system, which is an order-driven automated matching system. It does not reveal the identity of parties to an order or a trade, which means nobody's buy or sell order is driven by their identity. But how is the buy or sell price of the share determined? At any point of time, there might be many buyers and sellers of the same stock in the market. For example, you might decide to buy 10 Reliance shares for 900 rupees. And at the same time, two anonymous sellers decide to sell 5 Reliance shares each for 900 rupees. The computer system will automatically match your buy order with the two sell orders to complete the transaction. This order matching happens on a price-time priority. Hence, when there are more buyers for a stock in the market, then the stock price tends to move up. And when there are more sellers, then the price will move down. But what happens if there are no sellers for the share that you want to buy? If your order does not find a match, it remains in the system and is displayed to the whole market till a fresh order which matches comes in or the earlier order is cancelled or modified. But your transaction is not yet complete. The shares that you buy will not immediately reflect in your demat account, as the NSE follows a rolling settlement on a T+2 basis, which basically means If you place an order on Monday, that is transaction day, it will get settled by Wednesday. So, if you buy 1000 shares of a company at 100 rupees per share on Monday, you will have to give a total amount of 1 lakh rupees to your broker latest by Tuesday. And the broker in turn has to give this money to the stock exchange by the third day, which is by Wednesday, to complete the transaction and for the stocks to reflect in your demat account.
Once the orders are received into the system, they are allotted a timestamp. Once the timestamp and a unique order number is generated and given to by the system, these orders are then immediately pushed for its execution. To the extent the orders do not get executed because of price issue or because of the timing issue, these orders are then collected into the order book waiting to be executed. Now when these orders are collected and waiting into the system, there is a price time priority which the system gives. What do we mean by price time priority? Say for example, 2 orders of the same company arrives into the system, but the prices are different. Then the one which is at a higher price will get a higher priority for execution. However, in the other possibility, if 2 orders come into the system but both are at the same price, then the one which comes first into the system gets priority for execution over the another. This is with regards to order collection and pushing it for the execution. Now, how the actual execution takes place into the system is that all the orders, that is the buy orders and the sell orders, are actually categorized into best buy orders and best sell orders. These best buy orders and best sell orders are actually to be looked into from the counterparty angle. A best buy order therefore is the one which is at the highest price, and the best sell order is the one which is at the lowest price. Why it is so? Because a best buy order at the highest price, meaning the seller, the counterparty would like to sell it at the highest possible price. That's why it is at highest price. Best sell order being at a lowest price, meaning the counterparty, the buyer, would like to buy that particular security at a lowest possible price. With this logic, system would match the orders and eventually it would culminate into the trades.
But the role of a stock exchange is not just to act as a trading platform. It also has to ensure that all transactions are honored and all systematic risks for investors are minimized. Let's detail the risk management on the other side of this break. Stay tuned. Welcome back. You're watching Get Started in the Market. We all face uncertainty in our daily lives, whether it's our health, the weather, or even the traffic jam on the way to work. But we take preventive measures. Similarly, the stock exchange has also put in several preventive measures to manage the risk of investors and to prevent uncertainty.
NSE's risk management arm is called the National Securities Clearing Corporation Limited, or NSCCL. The main risk management measures implemented by NSCCL are ensuring that the obligations of trading members are in line with what they can actually afford. It ensures capital adequacy requirements are maintained. It continuously monitors members and their trades. And last but not the least, ensures strict margin requirements are maintained.
Once a trade is executed on the exchange platform, it has to be settled. So, supposing the buyer does not bring in the funds, what will happen? The seller will be left with the shares which he has already sold and he is waiting for the funds. What clearing exchange has done is set up a clearing corporation whose job is to be the counterparty for all the settled trades which are executed on the exchange, which are settled through the clearing corporation. So, essentially for all the settlements on the clearing corporation becomes a counterparty to all the investors. So, anybody who has bought the shares would be able to receive once they make the pay-in, irrespective of the fact that other party has delivered the shares or not, clearing corporation would step in and ensure the settlement is completed. Similarly, somebody who has sold the shares would be able to receive the funds irrespective of the fact that the other party has paid or not. Clearing corporation steps in and ensures that the counterparty risk is completely taken off. So for every settlement which is happening on the clearing corporation itself is the counterparty.
So why does an investor have to maintain margins? And how does this protect and impact you as an investor? We already know that your share transaction takes 2 days to settle, but fortunes can change in 2 days in the market. The price of the share that you bought could move up sharply, and the seller may want to back out of the trade in the hope of getting a better price.
So how does the exchange ensure that all transactions are honored at the price they were struck? This is where the margin system comes in.
Basically, margin is, when we talked about the counterparty risk, clearing corporation is actually taking the counterparty risk. For the clearing corporation to take the risk, it has to ensure that it has a skin in the game from one of the parties. Both the parties who are trading that particular, executing that particular transaction have skin in the game. So they need to, it's almost like performance guarantee. They need to put in some base level margin before they execute a trade. To ensure that people don't renege on the executions which have happened, clearing corporation collects margin upfront for every transaction which is happening on the exchange platform, and the margin is based, it's not a number which just is generated out of hat. It is based on the volatility in the market, and it is continuously recomputed based on the price volatility which is happening in the market. When the prices move up or down or consistently, there is a significant amount of volatility in the prices, the margins shoot up because the risk of uncertainty has increased. To cover the uncertainty risk, the margins might shoot up.
Let's understand this with an example. If you buy 1,000 shares of a company at 100 rupees per share, the total amount that you owe your broker will be 1 lakh rupees. But despite a T+2 rolling settlement, you would first need to make an advance payment to the broker to lock this transaction. This advance amount is called a margin, and it is calculated as a fixed percentage of the total amount. So in this case, if the upfront margin payable is 10%, it would mean you will need to pay 10,000 rupees at the time of striking the deal. To help us understand the concept of margins better, we have with us Mr. Bhavin Parekh, Deputy Vice President, Risk Management at Angel Broking.
Thanks very much for joining us. My first question is, what is the concept of a margin and how does this really protect the investor?
The margins are levied by the exchange. What happens is, let's say there are two counter brokers who are transacting in a particular deal. One broker is buying for a customer, another broker is selling for a customer. Assuming they don't pay the margin and exchange doesn't take any margin, and the settlement happens after 2 days. Till that 2 days, what if the broker backs out from their obligation? And if that broker backs out from the obligation, there is a chances that there would be a counterparty risk. To avoid the counterparty risk, exchange charges the broker the upfront margins. So, for example, if you buy 1 lakh worth of Reliance Industry, so exchange takes around 7,500 as VAR margin, which is 7.5%, and the balance margin is taken as extreme loss margin, which I'll explain you a little later what are these margins. But these margins are taken so that in case if the price goes down in Reliance Industry, the counterparty risk is been covered. Hence, exchange takes this margin upfront. Brokers are supposed to deposit this margin upfront with the exchange, and exchange then only allows a broker to transact for their customers.
Can you explain how the margin is computed?
Margins are computed based on the volatility of the script, and there are 3 kind of script categorization which is done by the customer by the exchange. Tier 1 scripts are basically blue chip scripts, Tier 2 scripts and Tier 3 scripts, and accordingly the margins have been computed. There are 2 types of margins. There is a VAR margin and there is an extreme loss margin. Over and above that, exchange also takes mark to market margin. So in case if the stock goes down, the brokers are the purchase broker has to provide with the additional margin as well by the end of the day. These margins have been computed by the exchange on real-time basis. So whenever you transact into a particular script, if as a broker you had not deposited your margins with the exchange, then your order would not go through. So the margins have been calculated by the exchange, and all the orders which are executed by the broker, first the margins are checked and then the orders are pumped into the system.
So how does the price volatility in stock prices impact the margin amount?
The price volatility has a larger impact on the margins. When the price decreases or increases with a very high volatility, then exchange revises margins, and this revision in margins would impact the brokers as well as the customers in turn, because then they have to shed out more margins for any transaction that they do.
So you mentioned the different types of margins. Can you just take us through what are these different types of margins?
Sure. Exchange in cash market segment, they charge VAR margin, which is that value at risk margin, which is a scientifically calculated based on historic price movements, based on volatility. This margin, basically what happens is, in case VAR margin is basically it covers 99.9 times risk on any given day. What it means is, out of 100 days, 99.9 times your margin would not get breached. Your volatility would not breach the margin requirement. But there is a chances that there is a 0.1% that the price movement would be more than the margins applied by the exchange. To cover that, exchange also charges extreme loss margin, which is a fixed margin, which is over and above the VAR margin requirement. And end of the day, whatever the price volatility happens, they'll mark to market the positions, and whatever M2M loss that has happened for the day till the time the settlement happens on T+2, till the time settlement happens, exchange would also compute mark to market and debit the broker accordingly.
Okay, so whenever I make a trade as an investor, will the broker charge me a margin amount every trade I make?
Generally what happens is, if you are on a sell side, if you want to sell your securities and your securities are already been lying with the broker, then a broker would not charge that particular margin. But assuming your securities is lying in other demat accounts and broker doesn't have the visibility, or they doesn't have the right to take the shares, they'll charge you this particular margin. But for every purchase trades, because of the broker's risk also, brokers would definitely charge the margin to the customer. Unless the customer doesn't keep a deposit with the broker, they will not be allowed to purchase any securities, so that unless the margins have been covered with the broker.
Okay, so basically unless I have a deposit with the broker, only then will he not charge me margin. Otherwise I will have to pay the margin.
Yes.
All right. Thank you very much for talking to us. While margins eliminate a large portion of the risk, NSCCL has also created a large settlement guarantee fund. This fund works like an insurance policy. The way you pay premium for an insurance policy, NSC members make a small contribution to this fund at predetermined intervals. But when is this fund used? When any trading member defaults and is unable to pay up, the amount comes out of this fund in order to complete the settlement. This has practically eliminated any risk of counterparty default on the exchange.
There is no default from the time we have started operations. The clearing corporation started in 1995. We have started operations in 1994. From that point onwards, there is absolutely no default or no delay in paying and payout of funds and securities. It happens on a clockwork precision throughout the period.
Before we end this episode, here are some important facts that you should know, but which often get overlooked.
If your broker does not resolve your complaint within 15 days, you can directly approach NSC's Investor Grievance Cell. The power of attorney section, that's often part of the account opening form, legally allows your broker to operate your account if you sign it. Did you know that this is not mandated either by SEBI or by the exchange, and it is entirely your decision? So ensure that you give your broker only a limited power of attorney with a clause to revoke it at any time.
With that, it's a wrap on this episode. We hope that the curtain of doubt about the equity market is slowly lifting. We'll be back next week to take this series forward and give you a peek into what are the various ways that you can invest into the equity markets. Until then, invest safe and invest wise.